What is going on, everybody? Welcome back to Trading Learning 101. Today's topic, we're going to talk about short selling. What is short selling? The risk of short selling. This is a little project that I've just thrown together using PowerPoint. I think you all will really enjoy it. If you're new to the channel, please hit that subscribe button. Join the Trading Learning 101 community where we all grow as traders and investors. And if you're interested in joining the Discord chat room that I have opened up for everybody, please feel free to join. I will leave a link down in the video description below. Short selling is very risky. I am blown away by questions I receive from people who are not educated on short selling, and they are jumping right into it head first. Short selling is very risky. Your losses could be infinite. You have many fees you must know about. I would not be shorting until I have screen time under my belt and I understand how stocks move and how to read charts. Hope that this video will open a lot of your eyes, especially new people, the dangers and the risk of short selling. Everything I talk about in this guide, I am not trying to turn you off against short selling or turn you into short selling. I simply want to point out all the risks and the rewards of short selling. I want to help educate on this topic. These are all my personal opinions before we move into this guide. I am not responsible for any of your losses, and I am not a financial advisor. This is not financial advice, and you should educate yourself before investing or trading any of your hard-earned money. Risk management. What most people fail to realize is if you want to get more involved with trading, it's all about risk management. I am a professional risk manager. For me, this is not gambling. I am managing my risk every day. I am looking for high probability trades that offer more reward than risk. I have a plan before every trade, my entry, my stop, which is my risk, my profit area, which is my reward, and I try to stick to the plan every day to the best of my abilities. This is my business, my trading account. You want to look at your trading account as your business and take this seriously. If you treat it like gambling, you will fail. What is short selling? Short selling allows investors to profit from stocks or other securities when they go down in value. In order to do a short sale, an investor has to borrow the stock or security through their brokerage company from someone who owns it. The investor then sells the stock, retaining the cash proceeds. The short seller hopes that the price will fall over time, providing an opportunity to buy back the stock at a lower price than the original sale price. Any money left over after buying back the stock is profit to the short seller. Short selling explained. Short selling is an investment or trading strategy that speculates on the decline in a stock or other security's price. It is an advanced strategy that should only be undertaken by experienced traders and investors. Traders may use short selling as speculation, and investors or portfolio managers may use it as a hedge against the downside risk of a long position in the same security or a related one. Speculation carries the possibility of substantial risk and is an advanced trading method. Hedging is a more common transaction involving placing an offsetting position to reduce risk and exposure. In short selling, a position is opened by borrowing shares of a stock or other asset that the investor believes will decrease in value by the set future date, the expiration date. The investor then sells these borrowed shares to the buyers willing to pay the market price. Before the borrowed shares must be returned, the trader is betting that the price will continue to decline and they can purchase them at a lower cost. The risk of loss on a short sale is theoretically unlimited since the price of any asset can climb to infinity. When short selling makes sense, at first glance, you might think that short selling would be just as common as owning stock. However, relatively few investors use the short selling strategy. One reason for that is general market behavior. Most investors own stocks, funds, or other investments that they want to see rise in value over time. The stock market has generally gone up, albeit with temporary periods of downside movement along the way. For long-term investors, owning stocks has been a much better bet than short selling the entire market. Sometimes though, you'll find an investment that you're convinced will drop short term. In those cases, short selling can be the easiest way to profit from the misfortunes that a company is experiencing. Even though short selling is more complicated than simply going out and buying a stock, it can allow you to make money when others are seeing their investment portfolios shrink. The risk of short selling. Short selling can be profitable when you make the right call, but it carries greater risk than ordinary stock investors experience. When you buy a stock, the most you can lose is what you paid for it. If the stock goes to zero, you'll suffer a complete loss, but you'll never lose more than that. By contrast, if the stock soars, there's no limit to the profits you can enjoy. With a short sale, however, the dynamic is reversed. There's a ceiling on your potential profit, but there's no theoretically limit to your losses you can suffer. For instance, say you sell 100 shares of a stock short at a price of $10 per share. Your proceeds from the sale will be $1,000. If the stock goes to zero, you'll get to keep the full $1,000. However, if the stock soars to $100 per share, you'll have to spend $10,000 to buy the 100 shares back. That will give you a net loss of $9,000, 9 times as much as the initial proceeds from the short sale. Still, even though short selling is risky, it can be a useful way to take calculated positions against a particular company. Managing your risk is important, but when used in moderation, short selling can diversify your investment exposure and give you an opportunity to capture better returns than someone who owns stock and other investments. Brokers and short selling. With short selling, I have learned it is good to have multiple brokers open, as every year brokers have shares available to short a specific stock changes, especially with small cap stocks and penny stocks. Shorting is getting more and more popular, and the demand for shorting is increasing, resulting in higher fees and finding shares to short. One broker might have shares to short for a variety of stocks all year long. Then the next year, they can't ever find shares. Therefore, it is important to have multiple brokers open, as you never know what broker will be the hot broker for shorting stocks. Short selling fees. The investor has to pay a fee to the lender for the borrowed stock, which is known as the borrowing cost. As we said before, the investor borrows the stock from a broker-dealer for the purpose of short selling. The broker lends these stocks from the securities that he holds or are in his custody on behalf of his clients. Some large investors owning their own stocks will directly lend in the market. There are 2 types of loans: call loans, which are the lender can terminate such loans anytime. This is the most common type of loan. Then there are term loans. These loans are provided for a specified period, for example, 1 month. These loans are for a given number of stocks rather than a particular value. These are secured loans, as when shares are borrowed, cash or another security is pledged as collateral. The typical fee for a stock loan is 0.30% per annum. In case of short supply, when many investors are going to short on a stock, the fee may go up to 20 to 30% per annum. Even though the stock is borrowed by an investor, the dividends still belong to the lender. So while returning the stock, the investor has to pay the fee along with any dividends received. Short selling fees continued. Here is a list of fees you must know. Broker locate fees. Even if you don't use the shares, the broker may charge you for locating and or holding the shares for you. HTB, hard to borrow. ETB, easy to borrow. Stocks are popular stocks like Facebook, Google, Tesla. Stocks traded with lots of volume every day. We know a lot of long-term investors are invested in these companies. HTB, hard to borrow stocks, are not traded much. Low volume. It is going to be hard for a broker to find shares. Shorting is very competitive, so most of the time it's first come, first serve. This means waking up early to locate shares and reserving them to have on hand for when you are ready to short the stock. Short selling 101. To open a short position, a trader must have a margin account and will usually have to pay interest on the value of the borrowed shares while the position is open. Also, the Financial Industry Regulatory Authority, FINRA, which enforces the rules and regulations governing registered brokers and broker-dealer firms in the United States, the New York Stock Exchange, NYSE, and the Federal Reserve have set minimum values for the amount that the margin account must maintain, known as the maintenance margin. If an investor's account value falls below the maintenance margin, more funds are required, or the position might be sold by the broker. To close a short position, a trader buys the shares back on the market, hopefully at a price less than what they borrowed the asset, and returns them to the lender or broker. Traders must account for any interest charged by the broker or commissions charged on trades. The process of locating shares that can be borrowed and returning them at the end of the trade are handled behind the scenes by the broker. Opening and closing the trades can be made through the regular trading platforms with most brokers. However, each broker will have qualifications the trading account must meet before they allow margin trading. Pros and cons of short selling. The pros: possibility of high profits. You need little initial capital required. Leveraged investments possible. Hedge against other holdings. The cons of short selling: potentially unlimited losses. Margin account necessary. Margin interest incurred. Short squeezes. When it comes time to close a position, a short seller might have trouble finding enough shares to buy. If a lot of other traders are also shorting the stock, or if the stock is thinly traded, sellers can get caught in a short squeeze loop if the market or a particular stock starts to skyrocket. On the other hand, strategies which offer high risk also offer a high yield reward. Short selling is no exception. If the seller predicts the price moves correctly, they can make a tidy return on the investment, primarily if they use margin to initiate the trade. Using margin provides leverage, which means the trader did not need to put up much of their capital as an initial investment. If done carefully, short selling can be an inexpensive way to hedge, providing a counterbalance to other portfolio holdings. Beginning investors should generally avoid short selling until they get more trading experience under their belts. That being said, short selling through ETFs is a somewhat safer strategy due to the lower risk of a short squeeze. Additional risk to short selling. Besides the previously mentioned risk of losing money on a trade from a stock's prices rising, short selling has additional risk that investors should consider. Shorting uses borrowed money. Shorting is known as margin trading. When short selling, you open a margin account, which allows you to borrow money from the brokerage firm using your investment as collateral. Just as when you go long on margin, it's easy for losses to get out of hand because you must meet the minimum maintenance requirement of 25%. If your account slips below this, you'll be subject to a margin call and forced to put more cash or liquidate your position. Wrong timing. Even though a company is overvalued, it could conceivably take a while for its stock price to decline. In the meantime, you are vulnerable to interest, margin calls, and being called away. You will hear many top traders say, do not try predicting tops. It is just like longs trying to bottom feed when trying to predict a stock's bottom. Stocks can do whatever they want. They all have their own personality. And just because something goes up does not mean it has to come down or come down immediately. The short squeeze. If a stock is actively shorted with high short float and days to cover ratio, it is also at risk of experiencing a short squeeze. A short squeeze happens when a stock begins to rise and short sellers cover their trades by buying their short positions back. This buying can turn into a feedback loop. Demand for the shares attracts more buyers, which pushes the stock higher, causing even more short sellers to buy back or cover their short positions. When squeezes happen, I love to call them supernova or parabolic moves. And also, when short squeezes happen, I like to call it a double whammy. You have shorts buying, covering their positions, and then on top of that, you have buyers coming in also buying. A double whammy. This is where you see stocks go supernova, parabolic, and just have a huge surge in price. Regulatory risk. Regulators may sometimes impose bans on short sales in a specific sector or even in the broad market to avoid panic and unwarranted selling pressure. Such actions can cause a sudden spike in stock prices, forcing the short sellers to cover short positions at huge losses. An example of this is when the oil attack happened over the weekend. And when the market opened on Monday, oil prices had a huge gap down and inverse ETFs related to oil had huge gap ups. Going against the trend. History has shown that in general, stocks have an upward drift over the long run. Most stocks appreciate in price. For that matter, even if a company barely improves over the years, inflation or the rate of price increase in the economy should drive the stock price up somewhat. What this means is that shorting is betting against the overall direction of the market. Cost of short selling. Unlike buying and holding stocks or investments, short selling involves significant costs in addition to the usual trading commissions that have to be paid to the brokers. Some of the costs include margin interest. Margin interest can be a significant expense when trading stocks on margin. Since short sales can only be made via margin accounts, the interest payable on short trades can add up over time, especially if short positions are kept open over an extended period. Stock borrowing cost. Shares that are difficult to borrow because of high short interest, limited float, or any other reason have hard to borrow fees that can be quite substantial. The fee is based on annualized rate that can range from a small fraction of a percent to more than 100% of the value of the short trade and is prorated for the number of days that the short trade is open. As the hard to borrow rate can fluctuate substantially from day to day and even on intraday basis, the exact dollar amount of the fee may not be known in advance. The fee is usually assessed by the broker-dealer to the short client's account either at month's end or upon closing of the short trade, and if it is quite large, can make a big dent in the profitability of a short trade or exacerbate losses on it. Dividends and other payments. The short seller is responsible for making dividend payments on the shorted stock to the entity from whom the stock has been borrowed. The short seller is also on the hook for making payments on account of other events associated with the shorted stock, such as share splits, spin-offs, and bonus share issues, all of which are unpredictable events. Ideal conditions for short selling. Timing is crucial when it comes to short selling. Stocks typically decline much faster than they advance, and a sizable gain in a stock may be wiped out in a matter of days or weeks on an earnings miss or other bearish development. The short seller thus has to time the short trade to near perfection. Entering the trade too late may result in a huge opportunity cost in terms of lost profits. Since a major part of the stock's decline may already have occurred, on the other hand, entering the trade too early may make it difficult to hold on to the short position in light of the cost involved and other potential losses, which would skyrocket if the stock increases rapidly. There are times when the odds of successful shorting improve, such as the following. During a bear market, the dominant trend for a stock market or sector is down during a bear market. So traders who believe that the trend is your friend have a better chance at making profitable short sale trades during an enhanced bear market than they would during a strong bull market. Short sellers reveal in environments where the market decline is swift, broad, and deep, like the global bear market of 2008 and 2009, because they stand to make windfall profits during such times. When stock or market fundamentals are deteriorating, a stock's fundamentals can deteriorate for any number of reasons: slowing revenue or profit growth, increasing challenges to the business, rising input costs that are putting pressure on margins, and so on. For the broad market, worsening fundamentals could mean a series of weaker data that indicate a possible economic slowdown, adverse geopolitical developments like the threat of war, or bearish technical signs like reaching new highs on decreasing volume, deteriorating market breadth. Experienced short sellers may prefer to wait until the bearish trend is confirmed before putting on short trades, rather than doing so in anticipation of a downward move. This is because of the risk that a stock or market may trend higher for weeks or months in the face of deteriorating fundamentals, as is typically the case in the final stages of a bull market. Technical indicators confirm the bearish trend. Short sales may also have higher probability of success when the bearish trend is confirmed by multiple technical indicators. These indicators could include a breakdown below a key long-term support level or a bearish moving average crossover like the death cross. An example of a bearish moving average crossover occurs when the stock's 50-day moving average falls below its 200-day moving average. A moving average is merely the average of a stock's price over a set period of time. If the current price breaks below the average, either down or up, it can signal a new trend in price. Valuation reach evolved levels and rampant optimism. Occasionally, valuations for certain sectors or the market as a whole may reach highly elevated levels amid rapid optimism for a long-term prospect of such sectors or the broad economy. Market professionals call this phase of the investment cycle priced for perfection. Since investors will invariably be disappointed at some point when their lofty expectations are not met. Rather than rushing in on the short side, experienced short sellers may wait until the market or sector rolls over and commences its downward phase. Short sellers' reputation. Sometimes short selling is criticized, and short sellers are viewed as ruthless operators out to destroy companies. However, the reality is that short selling provides liquidity, meaning enough sellers and buyers to markets, and can help prevent bad stocks from rising on hype and over-optimism. Evidence of this benefit can be seen in the asset bubbles that disrupt the market. Assets that led to bubbles such as the mortgage-backed security market before the 2008 financial crisis are frequently difficult or nearly impossible to short. Short selling activity is a legitimate source of information about market sentiment and demand for a stock. Without this information, investors may be caught off guard by negative fundamental trends or surprising news. Unfortunately, short selling gets a bad name due to the practices employed by unethical speculators. These unscrupulous types have used short selling strategies and derivatives to artificially deflate prices and conduct bear raids on vulnerable stocks. Most forms of market manipulation like this are illegal in the US, but it still happens periodically. Here are a list of links that I have used to help make this presentation. I would like to thank Investopedia, The Motley Fool, Finance Train, Quoria. I will leave these links in the video description. I want to thank you all for watching and supporting the Trading Learning 101 channel. If you are new, please subscribe. Join the Trading Learning 101 community where we all grow as traders and investors. If you enjoyed this video, hit that thumbs up button, leave a comment down below. What are your opinions on short selling? Do you actively short sell? What are your thoughts on this video? Again, I would like to thank each and every one of you for sticking with me and growing this channel more and more every day. Without you, Trading Learning 101 wouldn't be where it's at today. So from the bottom of my heart, thank you. This is only the beginning, and I cannot wait to see the future or what the future holds for Trading Learning 101. Until next time, everybody, have that patience, have that discipline, and study, study, study. Later, everybody.
The most valuable commodity I know of is information. Wouldn't you agree?